Good morning from our global headquarters in New York. I'm Danny Berger. Manish Cranny is on assignment this morning. Welcome to Bloomberg Brief. Let's set your agenda. It is another record. Stocks break 5,400 for the first time as Wall Street bets on at least 2 Fed cuts this year. The G7 kicks off in Italy. Terms are agreed to provide $50 billion of fresh aid to Ukraine. And Elon Musk says that his $56 billion pay package will get the green light ahead of today's Tesla AGM. Well, welcome to the show this morning. It is the hangover from the CPI Fed party. It is another record in stocks. This time it's helped not just by a cooler CPI, but tech. Broadcom up some 14.25% this morning after strong earnings, thanks to their AI demand. As for 10-year yields, little change this morning. Some of the euphoria, the giddiness we had in this bond market yesterday after CPI was curbed by a sober Fed. Nonetheless, we did end the day about 8 basis points lower. 4.31% is where you stand on your U.S. 10-year yield. Perhaps the asset with the biggest turnaround yesterday in reaction to a more sober Fed was the dollar. Dollar ended the day lower today, slight strength, euro down. Barely down, unchanged this morning. 108 is where you stand on your euro dollar. Now, that Fed's latest dot plot, it did little to squash Wall Street's confidence in penciling in 2 rate cuts for this year. Perhaps the Fed is just a lagging indicator. Inflation data showed a second straight month of cooling. Here's what former Fed Vice Chair Richard Clarida had to say.
In some ways, the Fed got trumped yesterday by the data. The CPI numbers were very Fed-friendly. Even though you could argue the Fed on net was hawkish, it was on net a dovish day in markets given the CPI report. They are in data-dependent mode. I know it sounds trite, but I think they need to see a lot more good inflation data to have the confidence to cut.
There's a wide belief out there that perhaps the market is more right than the Fed's dots, that, again, they're just lagged behind. Here's what Peter Scheer of Academy writes, that we learned more from the CPI than the Fed, perhaps. The dots pushed 1 rate cut from this year into next year, largely expected, especially since the dots didn't have today's CPI print, or yesterday, rather. Joining us now is Katrina Dudley, Senior Investment Strategist at Franklin Templeton. This seems to be the refrain. Andrew Hollenhurst from Citi also said this, that, look, they just didn't incorporate the CPI into their dots. I don't understand this. Why not?
I think the one thing we've got to remember about the Fed is that they have been so clear. Isn't that great that we've got a Fed that's saying we're waiting for the data and we need to have sustainable prints of lower CPI towards that 2% target? So sustainability. And the one thing that we think that the market really doesn't appreciate is there's something happening in November. It's the U.S. election, yes. And we're one of many countries that are going to the polls this year. But for the U.S., the Fed really doesn't want to be seen to interfere in that election result. So that also is going to impact some of the timing. So you may have one of those rate cuts kind of be pushed into next year.
So wait, do you think that affected some of what we heard, what was interpreted as hawkish? It was actually just Powell and team playing a little bit of a waiting game until the election.
I think that's exactly right. And don't forget, the beginning of the year in terms of, the calendar is just an arbitrary date. And so, if it moves a month out, does it really change the fact that, Wall Street's expecting 2 cuts? I think, the Fed's guiding to 1 this year, maybe 1 early next year.
So do you think that if they had the CPI in hand, actually it wouldn't have really changed the dots?
I really don't think it would, because the CPI is kind of gradually doing. And if you look at some of the comments, you look at what's happening in the Euro region, they keep telling us that this last mile is that hardest mile. If you're running a marathon or you're in a race, you kind of get the first miles in and it's easy and you're running along. But when you have that last one, yes, you can see the end in sight, but it's a tough race.
Well, Powell was asked, why not just do an ECB, if you will? Why not just cut once in the summer, wait and see how things go? He said that there are risks for both waiting longer and moving too quickly, that both of them have risk. What do you think is the bigger risk?
I think that the bigger risk is going too early. I think that the economy, the data that we're seeing out of the economy is really positive. You look at the jobs number, you look at the earnings number, and it's a positive, positive momentum, particularly here in the United States. A lot of people are focused on the Magnificent Seven. Yep. They're also focused on the technology, and that's been a big driver of the earnings number. But there are other parts of the economy that are doing well. The industrial sector is continuing to print good numbers. that our old-fashioned utility sector is actually also printing good numbers. They're another AI beneficiary as well.
Yeah, I mean, it's kind of turned into a mad world when like your safety stock is all of a sudden an AI stock as well, but that's what we're living in.
Yeah.
I mean, I can't help but wonder, okay, so the inflation number looks much more benign. It's looking much better. And this was discussed a lot in the Powell presser too, that you still have the oddity of owner's equivalent rent. You still have a housing inflation that's lagged, that's still higher than presumably it actually is here today in reality. So doesn't that mean that inflation actually is pretty much at target, and you could almost celebrate job well done once you take away some of the housing oddities?
Some of the housing oddities are just a slight delay effect. So, for example, if you rent, most people enter into a contract, there's a 1-year delay, in terms of repricing that because of just that natural cadence. And I think that that's the first indicator. And that data has always been on about a 6-month delay anyhow. So you're 6 months plus another year. I think we're seeing that. But have a look at some of the other underlying components where we're seeing some kind of interesting movements. The auto insurance, for example, insurance rates. And if you've tried to get car insurance, I know most people in New York probably don't, but most of America drives a car. And they're seeing rate increases of 20+%. All of my friends who moved to Florida are seeing huge increases in their insurance as a result of, flood risk and all of these other things. So, there are still pockets of inflation, and some of those pockets are actually driving significant moves in the CPI. As we look, however, at the Fed, what we want to see is kind of just guidance, and what you're seeing from the Fed narrative is that we're continuing to watch and we will continue to monitor. And as soon as it's justified, we can drop rates by 25 basis points, but we need to see real progress over a number of months.
Right. By the way, I love that you say all of my friends who've moved to Florida, because we all have all of those friends who have moved to Florida. They've all done it post-COVID. Look, there's this argument, Omar Sharif basically makes it, that if you look, for example, at their long-term projections, something like 2.6%, they're still elevated, which gives this idea that not only is the Fed not super confident that inflation is all the way reined in, but for the long term, they're not as confident. He calls it inflation PTSD, basically from the first rough quarter. Do you think there's some element of that that's hesitancy to say our long-term rates, we can get them back to where we want them to be?
I think in terms of that 2.6 number, I actually think that, when we're looking at close to 2, we've been debating what close to 2 means. Does it mean between 2 and 2.5, and then 2.6 there is not that different from getting under the 2.5? And I think that's where that guidance number is. 2 is a comfortable number for an inflation number. It's kind of that Goldilocks scenario, not too hot, not too cold. And I think that that's what the market is pricing in. What we're looking at is, the ability of companies and the ability of the economy to adjust to, higher interest rates, the ability of the companies to be able to adjust to higher inflation. And don't forget, they're actually, the second derivative is really that important number, and they're starting to see that kind of come down. And so you've got a lot of good things. We have the AI trend. So we're actually, I'm optimistic. Yeah. I think that, a lot of people are very critical about our ability to soft land this economy. I've seen things that said soft landing now is the bull case, but I actually think that's still exactly where we're going to end up.
On the AI trend, there's been much debate over whether or not it actually leads to this productivity boom akin to what we saw in the age of the internet. Torsten Slok was on this program not too long ago and basically said it's not going to be the same. It's not like the internet where everyone can just wholesale adopt it. AI is different. Do you think we're going to see an internet-style productivity boom from AI?
So I use AI. I mean,
here I am. Katrina, this is what I want to know.
Exactly. So I use it to make my time more productive. So if I'm looking at meeting with someone, I can use AI to help me generate an agenda. If I'm writing something, I can put it into AI and I can help it make me a little bit more productive. So if I look at the use for me, it's kind of taking my existing job and making me more productive.
Does this mean you're buying the new iPhone, the new AI-enabled iPhone, Katrina?
I am waiting at the moment. I have kind of a slightly older version, but it's an example of someone, of my generation, basically saying AI can make me more efficient. At the moment, it is making me more efficient in my existing processes. But I look at what we're doing as a company, and I look at some of the use cases we're investigating for AI within our research process, and some of those use cases are really innovative. And I think that that's the next bolus of productivity to come. So it's kind of It's still in development, it's still early days, but you have the people like me automating existing processes and these new processes to come.
Right.
So I'm actually a lot more optimistic.
You're going to have to give me a lesson on how you do these things. That sounds excellent.
Oh, it
sounds like
is.
it's going to take my job, though, so I'm a little bit concerned about that.
It actually won't.
Oh, that's good.
The interesting thing, because when you look at it, you write the content, it just elevates it. It makes what is good kind of better. And I think that that's the thing that people don't understand. The other element is AI is great, but it doesn't, it just can't replace the fact that we have the ability to make connections that other people can't. We have the ability for innovative thinking. I think that the human will not be replaced. But we've heard this argument before when we automated farming, and look where we are today.
True. Well, Katrina, you're helping me sleep a little bit better at night, so I appreciate that. Katrina, thanks for your time this morning. Katrina Dudley of Franklin Templeton. Okay, let's get you some of the other top stories that are trending on the terminal this morning. Speaking of AI and Apple says that it is not paying OpenAI to use its chatbot. Instead, Apple believes that promoting ChatGPT to its users is of equal or greater value than monetary payments. That, according to people familiar. Separately, Sam Altman told staff that OpenAI is on pace for $3.4 billion of annual revenue. Elon Musk says 2 shareholder votes are passing by a wide margin, his pay package and moving Tesla's headquarters to Texas. Both Musk and Tesla have been rallying support for both measures in recent weeks. The shareholder meeting does take place later today. Jim Chano sees plenty of opportunities for short sellers as the relentless bull market leads to bloated valuations. Chano spoke yesterday on Bloomberg The Close.
I've called this the golden age of fraud. So there's just so many companies, so many companies now that are playing games that are trying to take advantage of investors. So we need short sellers more than ever.
Coming up, we're going to bring you our exclusive interview with OMV CEO Alfred Stern as the oil and gas giant grapples with court cases that may jeopardize fuel flows. That's to come on Bloomberg Brief. It's your Bloomberg Brief. I'm Dani Berger in New York. So European gas is extending gains for its 4th day. It's trading at about the highest in 6 months. This as Germany's Uniper has been awarded 13 billion euros in damage after Gazprom cut off their supply of Russian gas back in 2022. Austrian energy company OMV warned last month that these type of court cases may disrupt overall fuel flows, given that more than 80% of Austrian imports over the last 7 months have come from Gazprom. Joining us now for an exclusive interview is OMV CEO Alfred Stern. Alfred, good morning to you. Thank you so much for joining. So the concern here, essentially, Uniper gets $13 billion in damages. That if Gazprom isn't paying this, then you'll have to redirect the money you're paying in your contract to Gazprom to Uniper. So we've gotten this court decision, 13 billion euros. What now, Alfred?
Yeah, good morning, Danny. Great to speak to you. Indeed, this is apparently what one could see in the press about Uniper. And I can confirm to you that OMV has released an urgent market message a few weeks ago that was highlighting such a risk, because what could happen is that the payments of anybody to Gazprom in Europe could be seized and relieve then the party of its debt to Gazprom. So that is a potential risk. We have been preparing for such events for the last 2 years. We have diversified our supply sources. We have booked pipeline capacity so that at any time we can ensure that we can deliver all our customers also with non-Russian gas in case such a interruption should happen.
Okay, so Alfred, just to be clear, because I think, there is some concern of the scale of interruption of flows. So if this happens, you can't pay Gazprom, the contract isn't existing in its current form. Just what does that look like? Is there any level of disruption or flows? Are you prepared at 100% to continue to deliver the fuel that is needed in Austria?
Yeah, we are prepared 100% for all the customers that have contracts with OMV to replace that with non-Russian gas. We have spent a lot of time and actually worked hard to make sure we have access to our own equity production in, for example, Norway. But we have also made third-party contracts in Norway, in Italy. We have made long-term LNG contracts and can use our capacities at the Gate terminal in Rotterdam. And then we made all the pipeline bookings to get us to the markets where our customers are active, so that we can supply at any time the customers with gas, with non-Russian, in case the supply from Gazprom stops.
I mean, there's other threats from the flow of Russian gas. One is that Ukraine is unlikely, and has said so, that they're not going to extend their contract to have Russian gas flow through Ukraine. You say that you're ready, you're prepared for alternate routes. But Alfred, what sort of market reaction do you expect? It's been a volatile market. If these types of flows cease to exist at the end of the year, what happens?
Yeah, so in Europe, the supplies from Gazprom have reduced, the pipeline supplies have reduced significantly. There are still LNG supplies from Russian gas coming to various countries in Europe, but the pipeline supplies have reduced significantly. But there is a few countries, and mainly the pipeline through the Ukraine, where still Gazprom gas comes to Europe. That is lesser than it used to be, and with this one should expect a smaller market effect. We at OMV, our Gazprom contract is such that the supply location is the Slovakian-Austrian border, and we expect the deliveries to happen there. If they don't, we are prepared at any time to supply also non-Russian gas.
The irony is, you say that there won't be too big of a disruption to markets. You see it a little bit because Europe, as you say, you have alternate routes. It is awash in natural gas supply, but we continue to see these little areas of disruption. For example, there have been outages. There's warm weather in Egypt. There's warm weather in Asia, making concerns about competition for the flows. There was a disruption to Libyan gas supply. All of these have had some impacts on prices, but not huge. Alfred, at what point do we actually need to start worrying about the continued disruptions?
So I think the supply demand picture in Europe, but globally in particular with gas, is volatile. I would agree with you. There's always two components. The price is driven by supply and demand, but then there's, of course, also a psychological aspect to the pricing at the hubs and the marketplaces. And what we have seen over the last 2 years is that every little disruption, if there's a issue anywhere in this world, that we see that very often this has very quick impact on some price changes. However, what we have not seen is the huge increases that we saw during 2022 and 2023, because a lot of rebalancing has happened. New LNG terminals have come on stream. People made new contracts like OMV have, like I just described before. But it will continue to be an issue. That's why, for example, we at OMV developed the EU's biggest gas project in the Black Sea in Romania with Neptune Deep, because we believe that supply production in Europe is one of the best security of supply measures that we can make.
Right. So there are scars of the crisis, but you've rerouted, you've readjusted. Alfred, you've also been having discussions with ADNOC to merge your chemical units, discussions which have stalled. What are the issues still holding back the merger?
So we continue to have ongoing discussions on a potential combination of Borouge and Borealis with an open-ended outcome. The industrial logic for such a deal is quite clear, I think, to bring together two leading companies, Borouge and Borealis, to make a bigger company there. I think we can all see that industrial logic, but of course, it's a high-stakes deal for both OMV and for ADNOC. It's also a complicated deal, and that does require in-depth discussions. We have more than 30 years of business relationship with Abu Dhabi. We are experienced in this, and we have made good experience to ensure that we are properly discussing the things before moving forward. So it's a complicated deal, open-ended, ongoing discussions. Okay. And we at OMV are focused to ensure that this is also value-creating, that the interests of all of our shareholders are maintained.
All right, Alfred, we're going to have to leave it there. Thanks for joining us this morning, the OMV CEO, Alfred Stern. Coming up on the show, a look at what else is making headlines around the world. This is Bloomberg. It is your Bloomberg Brief on this Thursday morning. I'm Danny Berger in New York. Let's get you some of your front page news. A look at what's making headlines around the world. First up on the AP, the G7 summit is opening. They've agreed to a deal for $50 billion in aid to Ukraine. Part of that is using frozen Russian assets to help the overall package. Separately, President Biden and Zelensky plan on signing a security deal. We are live, and we're going to have a live report for you from the G7 summit in Puglia, Italy, coming up as the world leaders meet there for their family photo. Next up on the Washington Post, former President Donald Trump will meet with Republican lawmakers on Capitol Hill today. His goal is to unify the GOP behind his agenda. It's going to be Trump's first public visit to the Capitol Hill since the January 6th attack. And how about this one on Bloomberg? Manhattan rents dropped in May. It's odd. It's usually a time in a season where rents are picking up in the demand of the spring. However, they are now at a median $4,250. That is a 3.3% decline. That's according to appraiser Miller Samuel. That is because there was more supply along with demand. Okay, coming up, we head to the world of private credit, a conversation with Anthony Fobel. Good morning from a beautiful sunrise over Central Park here in the New York headquarters of Bloomberg. I'm Danny Berger. Manish Cranny is missing this gorgeous picture. He is out on assignment. Let's set your agenda. Fresh record highs. Stocks break above 5,400 for the first time as Wall Street bets on at least 2 Fed cuts this year. Elon Musk says his $56 billion pay package will get the green light ahead of Tesla's AGM today. And G7 kicks off. Terms are agreed to provide $50 billion of fresh aid to Ukraine. The leaders meeting in G7. In the meantime, it is an equity market that is trading at all-time highs. Futures higher yet again, up 0.1%. It was a giddiness we felt after CPI. Okay, it was curbed by Powell and co., who had dots at just 1 cut this year. Even so, we are continuing to gain on both stocks thanks to Broadcom, a big tech earnings, a big Broadcom gaining some 14% in the morning's trade. 10-year yields, those are down by about a basis point. 4.3% is where they trade after a drop of 8 basis points yesterday. Finally, your euro dollar slightly weaker. The dollar did decline after we heard from Powell, a more hawkish Powell than perhaps we expected. So what does higher for longer mean for the world of private capital? We are seeing private equity deals picking back up. It's, of course, great news for direct lenders who often finance those deals. But again, it is a world of higher for longer. Joining us now to discuss all this and more, it is Anthony Fobel, CEO and founder of Arcmont Asset Management, which has 29 billion euros under management. Anthony, it is so great to see you. Thank you so much for joining this morning. So here we are, 24 hours out of a Fed, less than 24 hours out of a Fed who essentially did nothing and signaled they're just going to cut once. That after an ECB, which did indeed cut, divergences in with a stronger U.S. What difference does it make to you and your global allocation?
Well, first of all, very good to be with you again. And, you know, we've been in an environment now for a number of years where we have had pretty high interest rates. And for the private debt asset class, that's been a very good thing. One of the great features of this asset class is that our loans are variable rate loans, which does mean that as rates have gone up, really in response to higher inflation, the return for our investors has gone up. So I guess we're going to remain in an environment with elevated rates and I guess elevated returns for our investors.
It's great for your investors, Anthony, if I can jump in, those elevated rates. But there has been this criticism of the world of private debt that companies also have to deal with those elevated rates. And we've been in a world, again, this is the criticism of extend and pretend. Just be lenient to your companies and hope they can get through to maybe when rates are lower or something else changes. So what happens if we don't get that? Is there a maturity wall that all of a sudden looks more steep and more threatening?
Yes, I mean, I certainly think that higher rates has put pressure on a number of businesses. I suppose from Arcmont's perspective and many other players in the private debt industry, we have a slightly skewed portfolio in the sense that we are very much focused on businesses that tend to be less cyclical, but also very cash generative. So if I just look at our own portfolio, for example, we have very few businesses that have seen a lot of pressure on their cash flows as a result of the higher rates. As I said, that's probably not representative of the broader market, but that's certainly the case for us.
Yeah, the broader market has seen weird things, like, for example, Oaktree all of a sudden having to own an Italian football team because they breached the covenant and defaulted. I mean, this is an odd time. It's happened before, but maybe not to the scale, the size of private capital is. Anthony, you say you're prepared. You have these high cash flow companies. But is private capital, is private debt prepared for what's coming its way?
Yeah, but look, I think we have already been tested. You know, we've been living in this high rates environment for quite some time. It's remarkable that our portfolio companies are in many cases paying twice as much interest on their debt as they were probably 3 years ago. So, you know, the companies have accommodated that. I think that was also against the backdrop of a very uncertain economic environment. I think one of the things that has helped businesses is the fact that although they're paying higher rates, certainly in Europe, we've entered into a much better economic environment where companies are seeing growth as well. So I don't want to make light of the issue. I think there are businesses that will come under pressure. But, you know, in our industry, it's a sort of strange thing that, in a sense, us receiving too much interest is almost a high-quality problem, in the sense that there are things we can do about that. What we really care about are situations where we see declining EBITDA, because in those cases, there's very little we can do about it. And I will say, quarter on quarter, we have seen an improvement across our portfolio, generally, including things like interest coverage costs.
Well, Anthony, you've also said that you've seen a significant pickup in M&A activity. Can you just outline what exactly that pickup looks like? How far away are we from something that looks like the boom times of 2021? And what's the quality of that M&A?
So, again, private debt's been somewhat insulated from the decline in M&A volumes because during the last couple of years, you've had a period where effectively the banks haven't been lending and the liquid markets have been closed. So we've benefited from effectively being the only game in town. As you correctly say, Danny, we're now seeing an environment where the liquid markets are starting to open and open with a vengeance, particularly in the US. And so that's removed from private credit a lot of those higher larger deals, which historically would have gone to the liquid markets the private debt was doing. However, the countering factor to that is that we are seeing a quite dramatic pickup in M&A activity. And in many senses, we would be lead indicators. You know, we'll find out about those deals long before the markets do. And just to give you a sense of it, we've had a pretty good year in 2023. Year to date, our deal volumes are up 70% on last year. So we are definitely seeing that significant pickup. And a lot of it is driven by the fact that private equity firms feel that the economic environment is better for investing than it has been historically. But also, frankly, they've been sitting on dry powder for a couple of years and have to do something about it.
Yeah, deals need to get done or else LPs are unhappy. Anthony, there's also been a trend of consolidation, one that Arcmont has taken place in. Nuveen bought you about a year ago. Do you expect that to continue? Is there more consolidation to come in this industry?
Yes, I think it's inevitable. I think as the asset class has matured and essentially grown up, one thing is absolutely clear, that LPs, investors, want players with size and scale, partly because these are complex businesses. You know, if you look at our business, you know, we've got offices across Europe, we've got multiple products, it demands significant infrastructure. So investors are looking for scale players. I think also the larger players have managed to do larger deals, which by and large are safer deals. So that's also reflected in better portfolio performance. And you are seeing really a significant number of consolidation events. And certainly I can say from our perspective, us joining the Nuveen Group alongside our sister company Churchill has been hugely beneficial. You know, wherever I travel in the world, the fact that we can now say that Nuveen Private Capital has $74 billion of asset under management and a global presence is really resonating with investors.
Do you think it's healthy for private capital, for private debt to be specific, becoming the land of giants? Is this a good thing for the industry, that perhaps the smaller players can no longer survive?
I don't know if it's a good thing or a bad thing, but it's going to happen. You see, I think one of the problems with private credit and lending generally is there's no real upside in debt. What we need to focus on is getting our interest paid and returning money to our investors. And the thing that's always worried me about smaller businesses, and just to be clear, when we were a smaller business, we did smaller deals, is that they are riskier. And I'm just not sure you are paid for that additional risk you're taking. And so I think it will migrate towards being, an industry for large players. But like every industry, there will always be space for very high-performing niche players with very strong strategies and very good teams.
Okay, Anthony, thank you so much for joining us this morning. We appreciate your time. That is Anthony Fobel of Arcmont Asset Management. Okay, coming up, we're going to bring you a live report from Puglia, Italy, on the shores of the G7 summit. That's to come. This is your Bloomberg Brief. I'm Dani Burger in New York, and it is a full agenda down in southern Italy. G7 leaders are meeting. Details of a deal to provide Ukraine with $50 billion of aid using some profits generated by frozen Russian assets. It has been hashed out. Let's get over to Bloomberg's Anne-Marie Hordern, who's there in Italy, keeping track of the latest moves. Anne-Marie, what are the contours of this deal?
Well, this took months in the making, and my reporting, along with Alberto Nardelli and Victoria out of Washington, D.C. this morning, we have learned that a deal has been reached. So approximately $50 billion worth of a loan of cash by the end of the year will flow into Ukraine. What this means is that different countries are going to structure the loan themselves. There was a lot of discussions about the technicality of this. How would they be able to do this? The countries that are going to sign up for this, they will deal with it on their own on how they would like to give this loan to Ukraine, and then they will be repaid back as the interest of this about $300 billion worth of sovereign assets, these central bank assets, mostly held in the European Union. As they accrue interest, that interest then will be paid back to these countries that are front-loading this money to Ukraine. Now, we do know that some of these technical details will be continuously be discussed following the G7. They do want to get the money to Ukraine, though, by the end of the year. And Dani, what is really obvious to me is that the Biden administration, which for months has been trying to do this, as well as some of these other leaders, understand that there are some big elections coming up. Look at Rishi Sunak. Potentially the UK Prime Minister will not be the UK Prime Minister in about 2 weeks' time. Obviously, as well, a cloud hanging over this G7 is that potentially this is the last G7 for President Biden. So this is a way to foolproof future funds to Ukraine, and U.S. administration officials would tell you that that financing is dire need right now. It
is such a good point, and we're seeing just moments ago the pictures of Biden and Meloni greeting Macron there and Trudeau of Canada. It's also France at the same time, too, Anne-Marie. You make such a good point. This happening just after the European parliamentary elections. It is a whole host of leaders who are weakened. How does that color any agreement? Is what you're saying, Anne-Marie, that this potentially doesn't stick because we don't know who will be at the next G7 summit?
Well, the $50 billion, if they're able to get it there by the end of the year, that Ukraine will have that cash and they can start financing, and this would go to restructuring of their infrastructure that's in critical need. And this was a key goal for the Ukrainians. Dmytro Kuleba sat down with John and Lisa and myself at Davos, and he said this is the goal for 2024. And now we see the political will, and now we do see a plan that is going to be implemented following the G7. So that is why there was such a push to get this done. This G7 really felt like the final moment they can get this done. But for some of the other agreements potentially we could see on the sidelines here, potentially they will not be election proof. The President Biden will be sitting down Volodymyr Zelensky today, and they're going to be giving a joint press conference. And Zelensky came out and said that it's unprecedented, this bilateral security agreement that the United States and Ukraine are going to be signing on today. Potentially, this is another provision that the U.S. wants to election-proof. But the issue is this is not a treaty. It is not going through Congress. A future president could take the U.S. out of it. So that is why there is this cloud of uncertainty, and it's parochial almost, because these countries are dealing with immense amount of pressure at home that they come here without the mandate really of their electorate, given what we've seen with the parliamentary elections across Europe, except for Giorgia Meloni. She is the standout. And I will say, Danny, that this almost feels like a coronation of a new European leader at this G7.
Fascinating. Anne-Marie, thank you so much. Bloomberg's Anne-Marie Horton, who will be back with her surveillance team in just a short little bit of time. Surveillance starts in about 15 minutes. Okay, let's bring things back to here in the U.S. It's Tesla's annual meeting this afternoon. And it really means one thing. Shareholders, they have voted on Elon Musk's pay package, and we will find out the results of that $56 million price tag. Musk himself took to X to post that both the resolution to ratify his pay package and their move to relocate Tesla from Texas to Texas from Delaware are currently passing by wide margins. Let's bring in Bloomberg's Craig Trudell on this. So, Craig, is it happening? Is Musk finally getting his pay package of $56 billion?
Yes, it takes some of the drama out of the day, although it's very Muskian for him to sort of front run his own annual meeting. I also, just think it does, potentially reinforce some of the very concerns that Delaware raised about how this pay package came together and the extent to which the board is really governing their CEO, and that it's quite unusual for an executive to, ahead of an annual meeting, put something on social media about the state of voting. But nevertheless, this is something that the Tesla bulls were very concerned about, that if Musk was not able to get approval for this compensation, concerns about him taking his eye off the ball and potentially devoting more time and resources to his other ventures, and he has many other, as we know, whether it's X or XAI. It's very much been top of mind for the big investors who are still huge believers in Musk. That if he were to step back in any way, shape, or form, it would be a big setback for the company.
Yeah, and to that point, you can see there Tesla up 5.5% in the pre-market because of that. So, Craig, if this is a Musk who has gotten his pay package approved, is this now an emboldened Elon Musk heading into this AGM and just for the rest of this year? And what does that actually look like to take that off the table, this issue that he's been grappling with?
Well, I think one of the big concerns is that, this has all been a sort of distraction that in the end it hasn't necessarily been taken off the table, that this was a measure that really carried more sort of symbolic weight than legal weight. And Tesla acknowledges that actually in its proxy filing. So this is far from over. This is going to continue to play out in the courts. It may be the case that the company ultimately appeals this to the Delaware Supreme Court. But some procedures still have to sort of be taken care of before we get to that step. And all the while, we have seen signs that Tesla's underlying business, have not, particularly lit the world on fire. That the real concern has been this company relying on just a couple of models that do sell at high volumes, but have had some slip ups in terms of demand. And we don't necessarily have, confidence that, fresh product is waiting in the wings here.
Right. Craig, thank you so much. Bloomberg's Craig Trudell. And I also want to get you a quick check on Broadcom shares this morning. They're up about 12.5%. The chipmaker's quality results topped Wall Street's estimates. It had a chunky demand for its AI product, one of the only themes that can give you a win in today's market if you're actually turning out results and margins from it. Let's bring in Bloomberg Intelligence's Matt Bloxham on this. So, okay, Matt, Broadcom, it doesn't produce AI chips like NVIDIA. Instead, it's some of the components. But we've seen really diverging companies when they talk about AI for a market that rewards them or punishes them. So what's behind the reward this time?
Yeah, so I think there's a couple of things going on here for Broadcom. It's important to remember that a lot of what they supply goes into data centers, and data centers are at the heart of this whole AI boom. And so with the kind of first wave of the AI excitements around obviously NVIDIA and the kind of chips that drive the AI technology, but as those platforms in data centers get more and more complex and sophisticated and become kind of little networks of their own, then the expectation is going to be a huge amount of demand for the kind of technology that Broadcom provides to make all of that data center infrastructure work properly. And so I think a lot of people are expecting that as we get into that second wave and these data center based AI environments get more and more complex and bigger, that Broadcom's going to really benefit from that. And I guess as a kind of add-on to that, they acquired VMware, which is a really important software player in the whole kind of cloud environment. That's kind of giving them a kind of second wave of revenue growth in that area.
So potentially position themselves really well for this brave new world. Apple is also one of their top customers. I love that in their earnings call, they don't say Apple, but they'll say his North America customer or just some other kind of like vague thing that we all know, okay, you're talking about Apple. It's no secret what you're doing. How much of a difference does it make if we are about to get this AI-enabled upgrade cycle from Apple? What does that mean in turn for Broadcom?
Yeah, that's what I say. I think last year they inked a new multi-billion-dollar deal, and they're a key supplier of components into the iPhone. And yet the market seems to be getting more excited about a potential uptick in iPhone demand on the back of the kind of AI push that we heard about earlier in the week. So again, that's a kind of another leg, if you like, to the Broadcom growth story that may well kind of play out over the next 18 to 24 months if we do see that uptick in iPhone shipments come through.
Okay, exciting times. Matt, thank you very much. Bloomberg's Matt Bloxham there. Okay, coming up, we're going to get some more economic data today. We'll also hear from Secretary Yellen this afternoon. We've got it all covered for you here on Bloomberg in a beautiful morning in New York City. This is your Bloomberg Brief. I'm Danny Berger in New York. Manish Cranny is out on assignment under the beautiful sun somewhere out there in the world. Okay, let's take a look at what's ahead today. We're going to get more eco data. U.S. PPI hits at 8:30 a.m. Eastern, along with another round of jobless claims. Then New York Fed President John Williams will be moderating a discussion with Treasury Secretary Janet Yellen. That happens 12 p.m. here in New York. And the G7, that is in full swing for the next 3 days in Fasano, Italy. We've just heard an agreement that they reached a $50 billion package of aid for Ukraine. Okay, let's look at your movers pre-market. Tesla jumping this morning more than 4.5%, just under 5%. Musk has said that shareholders are backing his pay initiative. That annual meeting is scheduled for the market close. He's kind of spoiled it a little bit by saying that. He also says that they've approved his measure to move their headquarters to Texas from Delaware. Finally, Dave & Buster's, that is dropping after the earnings. Remember that company? A blast from the past, down 10 1/3%. Truist Securities analysts citing stiff macro headwinds that are hurting performance while a turnaround is still in progress. Meanwhile, in these overall markets, U.S. 10-year yields little changed this morning. But over the past 2 days, it has been a roller coaster ride. You can say yields drop right after CPI. That little tick higher is the Fed. And now we are just treading water. So where do we go from here? Is it 2 cuts or 1? Surveillance. That'll discuss up ahead.